Hey guys, welcome back to the Property Tank. Pumped for today. We're going to be talking about those crazy tariffs, the economic uncertainty that's going on and what that's going to do to property here in Australia. Interest rate cuts, what does that mean? Because that has a huge bearing on our property. Also, I want to talk about the rental crisis and the supply issues and how we're going to navigate that. What are the strategies we're going to use? All right, let's get into it. Please also, if you want to knock down, rebuild, dual occupancy, multi-development unit site, that is what we do. So please, Bonnie, in the descriptions, jump in there and do that. And please come say hello on IG. We've turned it on. Instagram profiles live. Lots of daily activity and things happening over there. So please go and do a follow over there and come say hello. Let's get into it. All right, guys, keen to talk about this one. President Trump and his tariffs. It's everywhere. It's trending everywhere. It's viral. He was going to smash the tariffs on everyone. Now they've put a 90-day hold on it. China seems to be the most affected. They're the ones in Trump's sights that he wants to level the ledger on and wrestle that power back. Now, what does that mean for Australia? What does that mean for interest rates here? So with all this economic uncertainty, what's it going to do? Australia has been very forthright in their mission on inflation. What's it going to do for inflation? So some people I'm listening to are hearing, does it push inflation up? Does it pull inflation down? I was listening to a pretty smart fella on the Mark Boris podcast the other day, shout out Mark, where all these tariffs in America make it hard for international traders to trade with America, makes their product a lot more expensive, such as China. So where does China and the other countries that are dealing with these tariffs, where do they want to sell their stuff? You know, all China's cheap cars. Are they going to sell them to America or are they going to sell them to Australia? So is that going to cause more of a supply-demand shift for imports coming into Australia, e.g. Chinese cars, coming into Australia, selling them cheaper, dumping them in Australia, causing inflation to go down in that category? That made sense to me. So with all that going on in America and tariffs going up and the walls going up around America, does that mean that frees up trade with other countries, including Australia? Obviously, it doesn't help us trying to export our goods into America, but as far as coming in and lowering prices of things, that made sense to me. Cheap Chinese cars in Australia, because their ability to trade with America they're becoming not viable at all. So that was an interesting point. Now, Bonnie, Jimmy Chalmers, our treasurer, come out this week.
Multiple interest rate cuts over the course of the year, beginning in May. Today in Australia, the market lost about 4% of value. On Friday, the US about 6%. We're also seeing this volatility in markets for gold as people look for safe assets. We're seeing it in the tumbling oil price as well. And we're seeing it in our own economy too when it comes to the Australian dollar bouncing around either side of 60 cents. That is largely a reflection of people's concerns about the Chinese economy, but it also reflects the fact that markets are now expecting around 4 interest rate cuts in Australia this calendar year.
Jimmy, out on a limb there, but 4 interest rate cuts this year. We've already had one. So that would make 5. So another 100 basis points this year. And we're in April already. Bonnie, they're meeting in May. What's going to happen there? Some people have suggested 50 basis points. So 0.5%. That's a big bump. They're proper moves, Bonnie boy. So what is this going to mean? And what is this going to mean to property? So the similar thing happened at the start of COVID, Bonnie, with this economic uncertainty, global economic uncertainty. They pull for the interest rate cuts to help keep things going, keep some confidence there and keep the Australian economy humming along. And then over here in property, what's that going to do? Well, we know what that does. That means people can borrow more. That means property comes back on the agenda in a heavy way. And then we've also got, so people's lending capabilities go up. So I was chatting to a broker mate of mine earlier. So people that are earning around that maybe 150K to 200K household income, if they could afford a property, say worth 1.2, it's likely that their borrowing capacity will go to 1.3, 1.4. And that sort of ratchets up as we get higher into those increments. So let's say a household is earning $250,000 and they're looking to buy a $1.6 million home. Very likely after an interest rate cut, a full interest rate cut that Jim Chalmers is predicting over the next circa 8 to 10 months, they're going to be able to afford nearly 1.8. And that's what drives our markets up. That's what gives people the ability to spend more. And as we know, an extra 100, 200K in a purchase price, extrapolated out over 30 years, isn't a big hit. And that's what drives competition. You've got more people being able to afford more. You've got this sort of FOMO effect going on, and we've got a housing shortage, Bonnie. So you got all these things coming in together, which we've been talking about this perfect storm for a little bit, but I think it is starting to come together, especially if we see 4 interest rate cuts this year. I think that's going to really do something.
If I'm thinking to buy a property this year, when should I get in?
Yeah, love it, Bonnie, love it. Well, the best time to buy property was 5 years ago. The second best time to buy it is today. But it's always your own circumstance, Bonnie. I'd like to say that. It's always the individual circumstance. That's the best time to buy for you. But Bonnie, like if we see 4 cuts, extra cuts, another percent, and people are going from being able to afford 1 to 1.1, 1.2, or 1.6 to 1.8, man, like these markets, and we see this over the journey when things happen. We saw it in COVID when interest rates got cut. There was economic uncertainty. Interest rates went down, and we saw it boom through COVID so aggressively. It moved so quickly. Like we'll get to halfway through the year very quickly, and then we'll be eyeing off Christmas. We might see the market move, 150 grand in 5 months. So to answer your question, Bonnie, if now's the right time for you and your own circumstance and your own financial security, man, let's go. Now, also keen to get into the rental crisis because that's feeding off the back of interest rate cuts, the property market firing up. What does that mean for rentals? What does that mean for people trying to find a rental? And then what does that mean for landlords and people getting inside the property market? And how does that affect our strategies? So some interesting stats that my man Bonnie has found for us. A couple of years ago, a household income of $116,000 would open them up to 60% of the rentals on the market. So 60%, that will get them into 60% of the market. Now, that stat is at only 36% of the rentals on the market. So for me, that's pretty damning, Bonnie. If I'm getting onto realestate.com, pressing rental, and my family's wage, only opening up 30% of that market, 36% of that market, versus 60% of that market a couple of years ago, that's a big deal. That's a huge deal. So what's driving those factors? It's the lack of supply, which we've spoken about, been well publicised. We've spoken about it here on the Prop Tank and on the Dev Tank. So we've got those issues and those headwinds. And we've also got the immigration stats that my man Bonnie, again, pre-COVID, we were circa 200,000, Bonnie, immigrants per year. And then during COVID, we dropped to sort of 70, 80,000. So very, very low. And then coming out of COVID, we're north of 400,000, Bonnie, immigrants. And that's where we're sitting at. Maybe some pent up sort of travellers from COVID, but the numbers are much higher and the government has said that they are going to be much higher. So all those people need somewhere to live, Bonnie. All right, guys, and keen to let you in on a little strategy that we're working on, Guru and myself, which is a property investment play based on all these factors that we're looking at. People are talking about coming back to Victoria. They're talking about the property growth in Victoria to outstrip all other states because they've had their run. It's Victoria's turn. We've got a lot of people calling us up saying, hey, how do we get active in Victoria? Now, the strategy is we're going down into sunny Geelong, looking at the infill sites in there and looking at brownfield sites in there, in the school zones, good sites, all those sorts of things. And we've got a client where we're doing a little dual occupancy, single story, 4-bed, and he's going to hold them and going to rent them out, Bonnie. Strong rents, low vacancy rates, and hold them and wait for capital growth. So he's going to put himself in the way of capital growth. He's going to buy reasonably well and low vacancy rates and strong rentals yields. So that's a play that these sites, old decrepit home on them, knocking them over, or a clean site and putting 2 high-yielding rental properties on them and waiting for capital growth and strong yields and doing depreciation schedules, virtually getting them to a positively geared situation, Bonnie. So that's how we're combating it, guys. That's a little strategy that we are working on with all these factors in mind.
PK, look like we need to go to see what's happening in Geelong.
Yeah, well, all the cool kids are down there. God's country. God's country, boys. But yeah, that's a little one that we're working on from a standpoint of low construction costs, because that's an issue. Little cheaper single-story dwellings. Renting them out. They always rent out well, the single dwellings, especially 4-bedders. And we're going to put ourselves in the way of capital growth as interest rates come down. And all these factors, a low housing supply, high immigration, rates coming off. We have that mix. Sounds like a good mix to me. All right, guys, that's a wrap. So wrapping up on today's episode, we've got the tariffs and the economic uncertainty out there in the global markets. What's that going to do to Australia's interest rates? Usually it means cuts, and our boy Jimmy Chalmers is predicting 4. So 4 interest rate cuts. So he's essentially predicting 1% in the rest of the year. We're nearly in the middle of it. So that's going to light the housing market on fire, I think. Then also we've got the rental crisis, and then our strategy at the end there, how we are navigating it from an investment point of view and how we're capitalising on it.
Question, PK.
Yes.
Last time I remember, was it $100, $150 with 0.25% coming off? We worked out off an average mortgage, I think you said 500-600. What does that look like, you know, with these, 4 cuts or whatever you're talking about?
Yeah, Benny, a bit of self-interest over here, but love it, because it's probably something I did miss back when we had the 0.25%, the 25 basis points. Benjamin, that was about $100, $150 a week for the average sort of loan, which is circa 500 grand. Bit more, I think, 500 to 600,000. A full percent will be circa $500 a month, Benny, which is getting to your $6,000, $7,000 per year, and that's cash. That's after-tax cash. You've got to earn 12, 13 grand per year, Benny, to after tax to pay your mortgage. So that's money, mate.
It's almost double that then, isn't it?
Well, depends which tax bracket you're in, Benjamin. But yeah, to answer your question, that's where that's sitting. So obviously, early on we spoke about lending capability. So Benny, late to the party, but just want to remind people that if someone or a household could afford maybe 1.2 million to buy a property, their lending will now be 1.314, and that's what's going to drive property. It's people's ability to spend more on the real estate they want to buy, and that's going to drive property up. But for the people that already have the properties and have the mortgages, they're the people that have battled through the last couple of years. You're going to save, on the average, $6,000 to $7,000 moolah cash folding, Benjamin. So that's pretty exciting for everyone. Obviously, the global uncertainty, you know, I'm not saying that's a good thing, but we are where we are, and it is what it is. So if Jimmy Chalmers is right, happy times ahead. All right, guys, that's a wrap from me. As a reminder, anyone that's looking to do knockdown rebuild, dual occupancy, multi-development sites, Bonnie, in the link below in the descriptions. Come across and say hello at Instagram. Lots of daily activities happening there. Lots of live action, so make sure you jump into that. Make sure you give us 5-star reviews, Spotify, and the other one, Benny, Apple. Give us one on Apple, and that's a wrap. That's it from me. Have a good week in property. See you next week. Heaps going on.